Most traders believe revenge trading happens after anger appears, after the pulse spikes, after the screen blurs. That belief feels logical. It's also wrong. The damage usually begins earlier, before the emotion has a name, before the body reacts. The loss isn't what breaks discipline, the response to the loss does. And most people don't notice the difference until it's too late. Here's the uncomfortable part. If you're trying to control revenge trading after you feel it, you're already behind. At that point, you're negotiating with a system that's no longer listening. At the time, it feels rational. You tell yourself you're just getting back to even. You widen the stop. You add size. You speed up decisions. Nothing about it feels reckless. It feels corrective. This is where traders usually get it wrong. Because revenge trading isn't emotional behavior, it's mechanical behavior triggered by emotion. And that distinction matters more than most people realize. This is timeless market lessons, where market wisdom outlives markets. There's a story that circulates quietly among veteran traders. It doesn't show up in motivational books. It isn't quoted in highlight reels, but it reshaped how risk is handled at the professional level. It involves a single trade, one moment, and the destruction of 6 months of disciplined gains. Victor Sperandeo learned this the hard way. He wasn't inexperienced when it happened. He wasn't reckless. He wasn't gambling. He had a system. He had rules, and he had consistency. Until one loss violated something deeper than his strategy. The trade didn't just lose money, it broke expectation. That's the detail most people miss. Losses are survivable. Broken expectations are not. When expectation breaks, the mind scrambles to restore balance. Not emotionally, mechanically. Position size changes, time horizons shrink, rules soften, and the trader tells himself a story that sounds like logic. Just one clean trade to reset, just one opportunity to recover, just one adjustment. Silence. That moment right there, that's where the damage starts. Not with anger, with urgency. Here's the pattern that repeats always. A trader builds consistency slowly. Risk is respected. Execution is patient. Then one loss hits outside the expected range. Not catastrophic, just unjust. The mind doesn't panic, it calculates. It asks a dangerous question. How do I fix this efficiently? Efficiency is the enemy in that moment, because markets don't reward emotional efficiency, they punish it. In Sparandeo's case, the next trade wasn't wild, it wasn't impulsive, it was bigger, slightly faster, slightly less selective. Nothing felt broken yet. Then another loss, then another adjustment. What followed wasn't a meltdown, it was erosion. 6 months of gains didn't disappear in one explosion. They leaked away through reasonable decisions made under pressure. That's what makes revenge trading so hard to detect. It hides behind competence. Here's a stat most traders never hear. The majority of drawdowns aren't caused by strategy failure. They're caused by risk rule drift after an unexpected loss. Not emotion-driven chaos, rule relaxation. This is a perspective shift that changes everything. If revenge trading were purely emotional, willpower might work. Breathing, breaks, positive self-talk. But it isn't. It's procedural. By the time emotion is visible, the system has already been altered. That's why most control your emotions advice fails. It treats the symptom, not the trigger. The trigger is the moment before emotion spikes, the moment expectation breaks. Sperandeo recognized this only after reviewing his own damage, not during the drawdown, after. He noticed something unsettling. Every destructive sequence started the same way. A loss outside expectation, followed by a decision made too soon. No rage, no fear, just speed. That insight forced a rule that felt excessive at first. Not a stop-loss change, not a position size tweak, a timing rule. After any loss that violated expectation, trading stopped. Not for the day, not until confidence returned, until the nervous system reset. Because the rule wasn't about markets, it was about biology. Here's where most people misunderstand this rule. They think it's designed to prevent bad trades. It isn't. It's designed to prevent altered behavior. You haven't thought about it this way before. The danger isn't the next trade, it's the version of you placing it. Once emotional arousal begins, access to prior rules weakens, decision speed increases, risk tolerance shifts upward, and no checklist fixes that. This is why the rule only works when applied early, before emotion, before urgency. Once you feel the need to make it back, the window has closed. Most people don't notice this until it's too late. They add safeguards after damage. They journal after drawdowns. They promise discipline tomorrow. But discipline isn't a future state. It's a pre-commitment, a mechanical decision made in calm, enforced in stress. That's the difference between amateurs and professionals. Not intelligence, not information, timing. If this resonates, subscribe. We explore these patterns weekly. The lesson here isn't dramatic. It's quiet, almost disappointing. There is no heroic self-control moment, no internal battle won, just a rule that activates before the battle begins. Sperendeo didn't eliminate emotion. He eliminated the opportunity for emotion to interfere. That distinction is everything. Revenge trading doesn't feel like revenge. It feels like responsibility. And that's why it's so dangerous. The internal conflict doesn't announce itself. It doesn't arrive as panic or rage. It arrives as competence under pressure. After a loss that violates expectation, most traders don't feel emotional. They feel alert, engaged, focused. This is what makes the moment dangerous. The mind hasn't lost control. It's speeding up. Reaction time shortens. Pattern recognition sharpens. Conviction increases. All of it feels useful. This is where traders quietly sabotage themselves. They don't abandon rules. They reinterpret them. A setup that would have been ignored an hour ago now looks acceptable. Risk limits become temporary. Size increases just enough to matter. No single decision looks irrational, but the sequence is. At the time, it felt logical. It wasn't. Here's the conflict most traders never articulate. They believe discipline is about restraint, but restraint is rarely tested in calm conditions. It's tested when urgency feels justified. The loss creates a subtle imbalance, not financial, psychological. The mind wants symmetry restored, not emotionally, structurally. That's why the next decision happens too quickly. Silence. Most people don't notice this until the account shows it. They think they lost control. What actually happened is worse. They followed a different system without realizing it. There's a story repeated across trading desks, different markets, different eras. A trader takes a loss early in the session, not large, just unexpected. They stay engaged. They don't step away. The next trade meets criteria, but barely. They take it. Loss. Now the tempo changes. The trader doesn't feel angry. They feel compelled. They widen their scan. They reduce selectivity. They trade more. By the end of the day, the damage is done, not because of one bad trade, but because the internal governor failed. Here's the stat that matters. Most drawdowns accelerate after the trader believes they're still in control. That's the trap. Control feels present because emotion isn't obvious, but control doesn't disappear suddenly. It erodes. The trader is still executing, just faster and slightly differently. This is the inner conflict, the belief that awareness equals safety. It doesn't. Awareness doesn't stop behavior, structure does. And this is where the realization begins to form. The problem isn't emotion, it's access. Under stress, access to pre-commitments weakens, not because the trader forgets them, because urgency reframes them. Rules written in calm feel optional in urgency, not broken, just postponed. This is why journaling after the fact feels useless. It explains behavior that's already happened. It doesn't prevent it. The realization comes slowly, often after damage. In reviewing sequences, a pattern emerges, not in setups, not in market conditions, in timing. Every destructive sequence begins with a decision made too soon after an expectation-breaking loss. That's the hinge point. Victor Sperandeo eventually articulated this without drama. He didn't frame it as emotional control. He framed it as system integrity. Once a loss violates expectation, the system is compromised, not mathematically, psychologically, and compromised systems shouldn't operate. This is what he understood that most traders resist. You don't wait until you feel emotional to stop. You stop because you will feel emotional. The rule isn't reactive, it's anticipatory. That's the realization. Markets don't care how disciplined you believe you are. They care how your behavior shifts under pressure. And pressure doesn't arrive loudly. It arrives as speed. Once you see this, old advice collapses. Take a break if you're angry. Step away when emotions run high. That advice assumes emotion leads behavior. In trading, behavior leads emotion. The act of rapid decision-making under stress amplifies arousal, not the other way around. By the time anger is present, the damage has already been done. This reframes risk entirely. Risk isn't just position size, it's state. And state changes faster than most traders realize. The decision framework that survives isn't complex, it's early. A single mechanical rule enforced before arousal protects everything else. No exceptions, no discretion. That's the part people struggle with. They want flexibility, context, judgment. But judgment is the first thing to degrade under urgency. The rule has to feel conservative, almost wasteful. Stopping after one expectation-breaking loss feels unnecessary until you've lived the alternative. Professionals accept missed opportunity as a cost of survival. Amateurs chase symmetry. This is the dividing line. If this resonates, the channel is built for listeners like you. Consider subscribing. The realization isn't inspiring, it's sobering. Discipline isn't heroic, it's preventative. And prevention only works when it's early. Once you feel the urge to recover, the system is already offline. That's not a personal failure, it's biology. The work isn't learning to fight it, it's learning to step aside before it wakes up.
After an expectation-breaking loss, the professional response isn't analysis, it isn't review, it isn't problem-solving, it's disengagement. That's the part most traders resist. They feel sharp, they feel capable, they feel like stepping away would be irresponsible, so they stay. The professional leaves precisely because staying feels justified. Here's what actually changes when the rule is applied correctly. The trading day doesn't revolve around opportunity anymore. It revolves around state. A loss that fits the model is processed normally. Execution continues. Nothing changes. But a loss that violates expectation triggers an automatic halt. Not because the trader is emotional, because they will be. The rule removes discretion at the most dangerous moment, the moment where judgment feels strongest. This is where amateurs and professionals diverge. The amateur asks, is this setup good enough? The professional asks, is my system intact? If the system is compromised, execution stops, no exceptions. This changes daily execution in subtle ways. Morning preparation becomes more deliberate. Expectations are defined clearly before the session begins, not vague, not optimistic. Clear enough that violation is obvious. That clarity matters. If expectations are loose, the rule never triggers, and the trader stays exposed. Professionals define their expectations narrowly on purpose. They want the rule to activate early. That feels restrictive. It is. Restriction is the point. Once the halt is triggered, the day changes texture. Screens go quiet. No scanning. No just watching. The nervous system is allowed to settle without stimulation. Most traders underestimate how long this takes. Not minutes, hours. Sometimes the rest of the session is lost. That's acceptable. What isn't acceptable is trading from a compromised state. Here's the consequence most people avoid thinking about. Ignoring this rule doesn't just risk money, it trains behavior. Every time a trader pushes through urgency and survives, the behavior is reinforced. Not rewarded by markets, rewarded by relief. That's dangerous conditioning. Eventually, the behavior appears automatically, faster, earlier. This is how traders lose years, not weeks. The application of the rule prevents that trajectory. It keeps drawdowns shallow. More importantly, it keeps behavior consistent. Consistency is the real asset. Over time, something else changes. Learning becomes clearer. Because damage is contained, review becomes honest. Mistakes are isolated. Patterns are visible. Without emotional residue, adaptation improves. Systems evolve without urgency. This is where lifestyle quietly improves as well. The trader isn't carrying unresolved stress into the evening. Sleep stabilizes, recovery shortens. Trading stops bleeding into identity. That matters more than performance metrics. There's a final irony here. This rule doesn't make traders more aggressive, it makes them more patient. And patience isn't passive, it's selective engagement. In Victor Sparandeo's framework, survival wasn't a byproduct, it was the objective. Everything else flowed from that. There's no clean ending to this lesson. Markets don't reward closure, they reward alignment. The rule doesn't guarantee profit, it preserves clarity. And clarity is what allows profit to happen over time. Most people will understand this intellectually. Very few will apply it. Because stepping away when you feel sharp feels wrong. That's the point.